you take out a 15-year note or a 30-year note on your mortgage? Hey guys, it's Eric and Neil, and we're getting into real money talk today on how debt actually works. We want to give you the confidence and clarity you need to understand money and make better money decisions. So this is a huge question that I love diving into, understanding the difference between different loan structures, maybe not different loan structures, but why would one person choose a 30-year note when you had the 15-year note option? And it's something that kind of unpacks one of the biggest misconceptions about money as we dive into it. So, it's kind of getting into this debt conversation can be a slippery slope. I was raised on debt is bad, pay off everything you can, never use credit cards, right? And I think our generation in particular, which I will not tell you how old I am, but our generation in particular was raised by parents who got introduced to credit cards. They were the first ones to really use it. They were the first ones to ever experience that space, and they got chewed up and spit out. It was bad. There were so many people who got into credit card debt. It was just this revolving line of high interest debt, and they didn't understand it. So when they got into it, it really, like I said, chewed them up, spit them out. So it's not that debt is a bad tool. It's that when you don't understand how to use the tool appropriately, right? Like a really big, strong, powerful tool, and they just cut their arm off, right? So when we look at this, and that's really what me in particular, I'm not trying to talk for you, but my parents taught me how dangerous and bad debt was. But now that, and they've gotten, a little bit more acclimated and learned things as well along the way. Now that I have started to understand how money works, I love me some, I don't like to use the word debt, but that's what it is, right? Leverage debt, you can call it whatever fancy name you want. But I maximize all of the credit card points and rewards that I can. When we talk about the mortgage, I'm not saying that I want to have a bunch of debt looming over me. By no means. No. But I do want to take advantage of the benefits that are available. So when we're looking at a 15-year versus a 30-year note, it's important that we don't confuse the message with the method. What do you mean by that? Well, your message is, I want to pay off my house in 15 years, Erica. I don't want to have debt. I don't want to have payments. And I just want to be, free of that. I totally get it, 100%. Your message is you want to pay off your house early. Great. Is the only way to accomplish that by taking out a 15-year note? No. So what I want to go into today is what do the other options look like? So if you know what your options are and you're fully informed on those options, then you can make a better decision for what makes sense for your situation. Now, as we dive into this, just know I am going to use some just general examples. This isn't, I'm not telling you what to do. This isn't advice, but it just kind of gives you some insight into how the different options can work so that you can take this information and apply it specific to your life. So let's get started. All right, so the first thing we're going to do is let's look at a loan analysis calculator. So the first one, we're going to look at 40 years. And we're going to say that you finance $400,000. I don't know how much you put down or anything. I just know houses are expensive now. So even a starter home is going to be $400,000. Now, based on this Fortune article, a 30-year conventional mortgage, current rate 6.813. And we still have 360 months to pay on this loan. So 30-year note, 360 months payoff. Your monthly payment would be $2,611.17. Okay? What if, though, you wanted your house paid off in 15 years? Well, you have the same $400,000 balance. Your loan rate now would be a 15-year conventional. So the current rate, 5.974. And we only have 180 months because we're doing a 15-year note. So at this point, you can see your monthly payment for a 15-year mortgage would be $3,369.81. Obviously, doing a 15-year note is going to cost you more than a 30-year note. Let's look at how much. So you're paying $33.69.81 as opposed to loan one, where you are paying $2611.17. Cool. You are paying an additional $758.64 per month. Said another way, $9,100 a year is going additionally to this mortgage. So obviously you're going to pay it off sooner, right? Like clearly that's why. But my question is, instead of applying $9,100 additional dollars a year directly to the mortgage, is there another route that you could use that will pay off your mortgage fast, like pay off your mortgage just like you want, but also continue to give you control over your money? Okay? And the answer is yes. So before we get into that, don't forget to like and subscribe and share this with your friends, family, and everyone in between so we can continue to teach them and share how money actually works. Now with this $9,100, we're going to go into an accumulation calculator. We're going to illustrate 30 years, easy enough. We're going to start with 0, 9103.68, payment, 9103.68. Cool. So now you're going to take your $9,100 and you are going to start saving it and investing it, okay? I'm just going to use a very basic investment portfolio. And I know you're like, oh my gosh, Erica, you always talk about investing. Listen, when I talk about I am not anti-investing. I am anti-lies. So I want to get into the reality of it, right? This is real money talk. So when I invest. I have investments out there. I'm all for it. So when I talk about investments, I'm not saying that they're bad or you shouldn't use them. I'm just saying it's important to understand how it actually works, right? We always talk about how volatility can change things. So I'm not going to come in here and put like a consistent 12% rate of return, right? Because that's stupid. We already know that. You've seen that in my other videos. But what we can do is go into the real numbers here. So we're going to go to the market history. And let's just, if you want it paid off in 15 years, let's look at the last 15 years. So the last 15 years, we're going to use the S&P with no dividends. If you invested in the S&P with no dividends, paste, cool. Let's look at this. So at the end of 15 years, when you've been investing $9,100 a year, you would have accumulated $384,414. Well, wait a minute. Let's come back to your loan. If you took out this 30-year loan, okay, you're not paying as much in your mortgage. What you're saving in your mortgage, you're applying to this investment account, okay? At the end of 180 months, we need to do 360 months. So at the end of 180 months, here we are. Your loan is, goodness gracious, 108. There it is. Your loan balance is $293,916. So when you've allowed your money to grow and compound, you have $384,000 available. So when we open up your calculator again, let's look at the difference here. You have $384,414. You owe $293,916. Not only can you pay off your house in 15 years, you have an additional $90,000 at your disposal. So you can let that continue to sit there and grow, right? A lot of people, I've seen this and I'm like, well, heck, at this point, when I look at my mortgage, I'm already starting to see more and more and more of it go to principal rather than interest. Now, the interest is still really, really heavy. That's a whole other conversation on amortization. But the point is, you're starting to at least see not most of it, but some of it going towards the principal. I'd rather just continue to pay that, and I just want to continue to invest. So, for example, if you didn't want to pay off your house and you just left this money continuing to grow, let's repeat the last 15 years. Cool. So, and we know it's not going to repeat, but the point is you're allowing your money to continue to grow and compound. Or, let's delete that, or with that $90,000, you can pay off your house. And I'll be honest with you, we've only been in our house 10 years almost. Yeah, 10 years almost. And we already have stuff going wrong. So this house, we bought it a couple of years old. So it is like 13 years old. And it's, oh my gosh, we've had to replace water pipes and, the water heater and all those things. So anyway, my point is that $90,000 can go into doing a lot of repairs on a house that you've already had for 15 years. But neither here nor there. My point is you have options. You are in control of your money and you get to decide what to do with it. So this 15-year note, absolutely, you could do that. But at the end of the day, you've paid off your house. Congratulations. How much money do you have in your pocket? I don't know, right? Because you're having to save whatever money you're not putting into your mortgage. Over here, you are putting less into the mortgage. You have less of your money being controlled by the bank. Less of your money is being controlled by the bank. More of your money is being controlled by you, and now you can put your money to work in a way that you think makes sense for your individual situation. So again, this is just to help you realize that you do have options. I'm not saying, hey, don't pay off your house. Sure, pay off your house, but let's do so in a way that puts control back into your hands and gives you options and gives you more money. So again, on the accumulation side, you can invest it into the market like we did here. You can put it into, put it into your life insurance policy, put it into real estate. I don't know. Now, is it an investment and can it fluctuate? Can it vary? Absolutely. Absolutely. So just be aware of that. We all know the market, and here, the last 15 years has obviously been ups and downs and all that good stuff. But I just kind of wanted to point out, hey, there are options available for you. You can pick and choose what makes sense for your individual situation. But when people say debt is bad, it's just that they don't understand the appropriate way to use it. I hope this has given you some cool insight. This was one of my favorite things to go through. This is some really interesting way to put money to work for you. Like I said, it's not that we need to have a whole bunch of debt and, crushing us and making us have that pressure. Absolutely not. But when you have these, radio talk show gurus that tell you to take all the money you can and put it into your house, I'm just going to tell you guys, I'm not for that. I'm not about that. I haven't been around a long enough to know that life throws curveballs. And when you have all of your money tied up in your house because every extra dollar that you've been saving has been going towards your mortgage, I get it. You're trying to reduce your mortgage and reduce your liability. However, what emergency money, what savings do you have sitting on the sideline? Because not if, but when somebody gets sick, somebody gets hurt, you have a car wreck or a massive liability or a repair on your home. Again, I feel like I've seen every single one of those just in the last 10 years. But my point is, if you don't have money sitting on the sideline, if you don't have money under your control, that money that you have in your house, let's be real, house values can vary. We're seeing that right now. They can fluctuate. We can also see there were times that we weren't able to take a HELOC. So during COVID, actually, banks were not lending money on home equity lines. Also, if you take out a home equity line of credit, you are subject to the bank's payback terms on that line of credit. So there's all these what if scenarios, but when you have money sitting on the sidelines that's under your control and that is really ready as an emergency fund for you, it can relieve so much stress and it can really get you out of a really tight situation. Now, the point is, like we said, you can always pay off your debt in 15 years if you want to and still have that little bit of cushion left over. So that's my passion, if you can't tell, having money and keeping yourself protected and in a position of control of your money and not being pigeonholed into, oh my gosh, I have to put, my kid broke their leg and my insurance deductible is $10,000. Now I've got to put all this money on a credit card because I've done nothing but take every dollar that I can and apply it to my house. So again, just wanted to point out the difference here. Continue, like I said, make sure you like and share and continue to subscribe. Let others know so that we can all continue to make better money decisions. And until next time, keep it real. At Infinity Investment Strategies, we teach investors and business owners how to become the bank. In using the infinite banking strategy, you can lower your taxes, increase the control you have over your own money, lower your risk against multiple wealth-eroding factors by adding additional layers of asset protection, and increase your leverage with guaranteed growth and the opportunity for dual rates of return. With authorized infinite banking practitioners with experience in business and investments, we are here to help enhance your portfolio.